Howard Marks, the billionaire co-founder of Oaktree Capital Management, one of the most respected minds in finance, just dropped a bombshell. He's warning of a massive change coming that could rock the very foundations of our economy. In a recent interview, Marks pulled no punches. He said the prolonged period of ultra-low interest rates, which many had come to accept as the norm, is over, and the normalization of interest rates will expose significant vulnerabilities for the US government. Let's sink in for a moment. One of the biggest players in the game is telling us that the rules have changed and the government is in for a rude awakening. Now, I don't know about you, but when someone like Howard Marks speaks, kind of sit up and pay attention. And frankly, I don't like the sound of rude awakening. This guy has built a net worth of over $2 billion by being right about these kinds of things, and he's not one to mince words. So in today's video, we're going to dive deep into what Marks is talking about. I'll explain how we got here, what it means for you and your money, and most importantly, what you could potentially do to protect yourself and even come out ahead of the game. But before we get started, I need you to do me a quick favor. If you haven't already, hit the like button and subscribe to the channel. I know it seems like a small thing, but it makes a huge difference in getting this information out to people who desperately need to hear it. We're living through a unique and dangerous period in American history, and the truth is we can't trust the government or the elites to look out for our very best interests. It's up to us to stay informed and vigilant, and that's exactly what I'm here to help you do. Okay, you did it? Good. Now let's dive in. First, we need to take a step back and examine the economic landscape of the past decade. For most of it, interest rates hovered near zero, and borrowing money was as simple as just asking for it. This era of cheap money lasted so long that it fundamentally reshaped our expectations, leading many to believe that rock bottom interest rates were the new normal. Well, as Howard Marks himself put it, we had a low interest rate environment which made life very easy for borrowers and asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history. We had the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And then, the pandemic happened. The world as we knew it came to a screeching halt. The government shut down businesses, imposed lockdowns, and the economy ground to a standstill. The government responded with unprecedented fiscal and monetary measures. To keep the economy afloat, they printed money at a level we had never ever seen before. And what did it lead to? Yeah, you got it, high inflation. And to combat this inflation, the Federal Reserve had to raise interest rates. Now we're sitting at rates around 5.2% to 5.5% after inflation hit a rate of nearly 9%. Now, to put this in perspective, these rates feel high to us now because we've been conditioned, if you will, to think that 2% was normal. But in reality, these are historically standard rates. If you look at the federal funds rate long term, you'll realize that 2% is far from the average. It's an exceptionally low stimulative interest rate. Rates between 0 and 2% are essentially emergency measures, and as Howard Marks puts it, you can't live on a shot of adrenaline every morning for 13 years. Currently, interest rates are around 5.25% to 5.5%, which is higher than Marks' preferred 2 to 4% range. The Federal Reserve is maintaining these rates because it's not fully convinced that inflation is under control. It's using higher rates to cool the economy until inflation aligns more closely with its 2% target. The real issue is that we've all grown accustomed to the lower interest rate. Businesses and individuals have taken on excessive debt, and now that rates are rising, well, it's causing major problems. However, private entities aren't the only ones feeling the squeeze. The government, as a major borrower, is also vulnerable to the effects of rising interest rates. For the past 2 decades, the US government has consistently run a deficit, forcing it to go deeper and deeper into debt each year to cover the shortfall. The debt's ballooned, particularly in recent years, due to the pandemic response, bringing the US debt problem to the forefront of everybody's minds. During periods of ultra-low interest rates, you'd expect to see a surge in leverage. The past decade has been strange though. The pandemic led to massive fiscal transfers, strengthening balance sheets for both corporations and households. So where's the leverage now? According to Marks, we know that the leverage is in the government. The government's taken on a lot of leverage, part of its rescue mechanism. The Federal Reserve's quantitative easing program, which involves buying bonds, has been instrumental in saving the economy during both the global financial crisis and now the pandemic. It's also loaded up the Fed's balance sheet with debt. The government still has to pay back the Federal Reserve when the debt comes due. The rest is assured. The check always comes, sooner or later. The Federal Reserve could theoretically turn on the money printer to buy more bonds and alleviate the problem. They can only do this if inflation is under control, because printing money and buying bonds is inflationary. Currently, inflation is definitely not under control. Let me say that again. Currently, inflation is most definitely not under control. The government accumulated a massive debt pile during the easy money period, and now that debt looks very menacing for two reasons. First, the government can't pay it back because they run a deficit. And second, when the debt comes due, they'll need to roll it over at much higher interest rates, which means they'll need to spend more money just to hold the debt. This takes even more cash out of their pocket than they were using for other things. So the question is this: can the government keep us afloat forever? Well, the answer to that is no, it can't. Howard Marks says the government helped us out during the pandemic, but it came at the cost of high inflation, which we now have to deal with raising interest rates. To keep the economy going through tough times, the US needs to spend money it doesn't have. This means turning to the Federal Reserve to buy fresh bonds. Right now, the Fed doesn't want to buy more bonds because it's inflationary, and they're focused on stopping the inflation. Kind of like a catch-22. So what needs to change? According to Howard Marks and the other experts like Ray Dalio, the US has to fix its deficit. If it doesn't, the problem won't go away. The US government has $32 trillion in debt and an annual deficit of around $2 trillion. While the US dollar is currently the world's reserve currency, meaning the government can print as much as it wants in the short run, it's not a sustainable solution, is it? So as investors, what should we look for during this period of relatively high interest rates that are likely to remain elevated for the foreseeable future? Well, let's face it, right? Most traditional investment vehicles, they're going to struggle. With interest rates on the rise, the stock market is becoming a less attractive option by the day. Typically, stocks flourish in low interest rate environments where cheap financing fuels rapid expansion. But in the high interest environments, the opposite is true. Financing becomes more expensive and growth slows down, leading to declining stock values. And as a result, money tends to flow out of the stock market and into bonds, seeking safer, more stable returns. That's why so many people are looking for an alternative to the stock market, something that allows them to invest with a measure of confidence and safety that they won't find in paper assets, something that Washington does not influence, and that Wall Street and the government and macroeconomic factors can't control. An investment that could provide passive income and build legacy wealth, and you could pass that on to their heirs. For years, I was a residential real estate investor. You might have seen me on A&E's Flipping Boston, where I flipped houses. I would find them, fix them, and flip them for a profit. I bought into the notion that residential real estate was the answer, the alternative to paper assets controlled by the elites. And I found out that I was both right and wrong. Real estate is the answer. They're not fixing and flipping single-family houses. Way too much work. I eventually moved into an alternative asset class that was not easily accessible to the public at that time: multi-family properties, specifically cash-flowing multifamily apartments in high-growth areas around the country. These private equity investments were reserved for the rich until recently. Now anyone can grow their income, portfolio, and wealth with tangible, appreciating, future-oriented private real estate assets. Anyone. Professionals who make good money but don't want to get involved in finding and managing these deals, well, they can even invest passively. They can invest in a private real estate fund that builds, buys, and lends to multifamily real estate projects throughout the country. By doing so, they can generate cash flow, increase their net worth, enjoy tax advantages not available through any other investment vehicle. Every multifamily apartment offers multiple streams of income. Think of it this way: each apartment is like a little cash flow stream, if you will, coming in every month. In the right locations, these investments appreciate in value over time. That's why we look for properties in cities and submarkets where we expect outsized rent growth and investment demand. We make as certain as possible that we have those advantages on our sides by relying on our boots on the ground. Boots on the ground are our local relationships with agents, brokers, bankers, other players that give us the real scoop about what's going on in a particular area. If you have any questions or comments about investing in these kinds of alternative assets, go ahead, post them below. I'd be interested to see your thoughts. I'll share some more information and strategies on this channel. And if you found this video interesting, please press that like button. This way you'll be able to see more videos on this topic. Subscribe to the channel so that way you get notified when new videos get posted. For Legacy Alliance, I'm Dave Seymour. I'll see you on the next one.